Well, happy new year to everyone. If you're watching this on my new YouTube channel, the first video of 2026, Brian Froley and I still work together all the time, but we have now officially split our YouTube channels, and this is our inaugural one on this new channel for this year, going over my top 5 stocks for 2026. Now, of course, I own shares of all 5 of these companies, but I want to let you know that you'll be seeing a score for each one of these companies called the antifragile investing score. It goes through my scoring framework. And there's really 3 big parts to it. The first is the barbell method. It takes into account the mission statement. That's a smaller part of the score. The moat, that's the largest part of both this subset and the entire score, and a company's optionality. After that, we look at redundancy, and specifically a company's financial fortitude, and if they have a single point of failure. Finally, skin in the game. We look at what role the founder plays, the level of insider ownership, and even Glassdoor scores. So the first one coming in at number 5 is one of my largest holdings, Mercado Libre. Now this scores off the charts on an anti-fragile framework. It has a wide moat and tons of optionality, still founder led. At the time of this recording, trading for about $2,000 per share, which I believe is moderately cheap. Now, what could be a catalyst for 2026? The increasing popularity of credit cards. They are seeing that division grow by leaps and bounds. And that's on the fintech side. On the e-commerce side, just continued growth in gross merchandise volume. The one big risk that could throw a wrench in this in 2026 would be the credit portfolio. Mercado Pago and Mercado Credito are growing by leaps and bounds. And if they end up making poor loans, then that could come back to bite them. So that is the key risk to watch there. And that's why it lands number 5 on my list. Coming in at number 4 is Duolingo, the language learning app. Now, it has an anti-fragile score of about 10, which is not the highest score, but part of that is because it is still proving itself. Whether or not all of the data that it has collected and whether or not that is a reliable network effect is still up in the air. That being said, at around $100, $180 per share right now, I consider this valuation to be extremely, extremely cheap for a company that's grown so fast and has such wide free cash flow margins. Now, the catalyst for this year is really going to be, they've talked about the top of the funnel, getting more people in. So if they have more free users that are coming in, monthly active users, that's one thing. But the other is if they can convert more of those free users to their paid plans, especially Duolingo Max, which is where I think the real traction could come from. But the whole reason that the stock is down so much is because it seems like they're having some trouble converting those free users into paid users. And the big fear is that this is all because AI will render this useless. Now, I don't necessarily buy that because I think that one, people, if they're using Duolingo to speak to others, they don't want an intermediary. And 2, this is more about gamification than anything else. It's a healthy addiction, if you will, and parents and kids are happy to have that be their addiction. Will that end up being the case? We'll wait to see, but I do believe those will be the drivers and the brakes that could cause Duolingo to move the most in the year ahead. Now, coming in at number 3 is a stock that I owned, I sold, and I've bought back into again, which is Transmedics. For those unfamiliar, this company not only makes machines that keeps hearts, lungs, and livers alive for longer during the transplant process, but is also vertically integrated and owns an airline to transport those organs so that they can be ready for the donation process. Now, right now, you might notice that its anti-fragile score is relatively low, but a big part of that has to do with the fact that this moat is emerging right now. And if you look at the catalyst, the approval for the next generation of heart and lung is going to be a big deal that can add to the moat, as well as approval for a new kidney device as well. As it is, the liver drives the vast majority of the growth here, but if it can get those approvals, it will only add more to the company's moat. I think it's slightly cheap based on today, and it's worth pointing out that the company at one point said, we'll do 10,000 organ transplants by 2028. And for a long time, that was the goalpost. Recently, they moved it, but in a really great way, saying that they believe that just 2 years later, there'll be between 20 and 30,000 organ transplants. Now, the biggest risk is if they don't get FDA approval for the next generation heart and lung or for the kidney. The other risk kind of is against a procedure that could be taking market share, which is called neurothermic regional perfusion, which some people think could take away some of the business from this in a way that serves others because organs are more available for transplant. But how that all shakes out remains to be seen. Those FDA approvals are going to probably be the biggest drivers to whether or not this ends up looking like a prescient pick on my part or like I was making a really dumb decision. We'll have to wait and see how things turn out. Now, coming in at number 2 is a stock that I actually just recently added to my portfolio. And you'll also notice that the antifragile score doesn't look so hot. Now, part of the reason for this is that I tend to focus on founder-led companies. And this is not a founder-led company anymore, even though the CEO has been there for a long time. That dings it on some points. And the other reason is I don't necessarily think that there's a ton of optionality with Adobe left. I'm glad that they're moving into a combined creative professionals and commercial professionals combined into one, but I don't see much more beyond that. Now, I could be wrong, and maybe that anti-fragile score should be higher. So why does it end up here? Well, because I think this is crazy, ridiculous cheap. I know if you look at the risks, the main threat to this is free or cheap AI tools, Figma and Canva, and then a host of others out there taking business away from Adobe. And while they might have more useful AI tools right now, my argument is that this stock is priced as if revenue will not grow at all moving forward. I simply don't think that's the case because it is so ingrained into professional agencies that pulling it out is incredibly painful. And so that's why the catalyst is just there just needs to be good enough execution. And I think this ends up being a winning bet. Now, it's worth noting that I have been tracking my own returns since the end of 2014, and you can see my results in the green, handily outperforming the S&P 500, which is in the red, and the NASDAQ Composite, which is in the yellow. If you would like to find out more about how I've done this, you can hit the link in the show notes below, which will bring you to an absolutely free investing ebook, the Adapt Investing Framework, the one that I used, a complete visual guide to building a world-class portfolio. So, what ends up at number 1 for me for 2026? It is none other than Sea Limited. Now, for those that are unfamiliar, this company primarily functions in Southeast Asia, thus Sea Limited. It has a gaming division. Its core game is called Free Fire. It has an e-commerce division like Amazon called Shopee, and it has a fintech division, something like Mercado Pago or PayPal for those of us in the United States. It, I believe, is a wide moat company with many of those moats in the process of growing right now that is founder-led and has proven to have tons of optionality. At the time of this filming, shares were trading for about $125 per share, and I consider that to be ridiculously cheap. The main reason is that I think that some people are worried about the risk of TikTok Shop taking away some of the e-commerce business in Southeast Asia. They're worried that Free Fire, the core game in the gaming unit, could stall. And that's important because while it's not part of my long-term thesis, Free Fire does provide a ton of the operating profits that fuel the growth that the company is going after. Really, the catalyst is there just needs to be continued execution. And then if there is, I do believe that this stock will prove to be cheap, not only in 2026, but over the long run. So those are my 5 top stocks for 2026. Let me know what you think and which ones you would choose in the comment section below. Don't forget to hit subscribe so that you can keep up tabs on these 5 companies. And until next time, Brian out.